Sit down. I need to tell you something that Wall Street doesn't want you to hear. My name is Warren Buffett, and I've been investing for 73 years. I've seen the dot-com bubble. I've seen 2008. I've seen Black Monday in 1987. But right now, in February 2026, I am more concerned than I have been in over 2 decades. Let me show you why. In 1999, before the dot-com crash, I sold most of my stocks. People called me outdated. They said I didn't understand tech. Then the market crashed 78%. In 2007, I moved Berkshire Hathaway to cash. People said I was too conservative. Then Lehman Brothers collapsed, and the S&P 500 fell 57%. Today, Berkshire Hathaway is holding $334.2 billion in cash. That is the largest cash reserve in our 60-year history. I'm not doing this because I like watching money sit still. I'm doing this because what I see in the market right now frightens me. There is one metric I have used my entire career to measure whether the stock market is overvalued. I call it my favorite valuation metric. The financial world now calls it the Buffett Indicator. The formula is simple. Total stock market capitalization divided by U.S. GDP equals the Buffett Indicator. When this number is below 100%, stocks are cheap. When it reaches 120%, start to be careful. When it exceeds 150%, the market is dangerous. Today, the Buffett Indicator stands at 205%. Let me put that in historical context. In 1999, at the dot-com peak, the indicator was 183%, and the market crashed 78%. In 2021, at the COVID peak, it was 203%, and the S&P fell 25% in 2022. Today, in 2026, it stands at 205%. We are in uncharted territory. The Wilshire 5000 has a total value of approximately $46.8 trillion. U.S. GDP is approximately $28.6 trillion. That means the stock market is 1.63 times larger than the entire U.S. economy. The S&P 500's current price-to-earnings ratio is 25.4. The historical average is 16. Stocks are trading at 59% above their long-term fair value. The Shiller CAPE ratio stands at 35.2. The only time it was higher? 1929 and 2000. You know what happened after 1929 and 2000. I am not alone in this concern. JPMorgan, one of the largest and most sophisticated financial institutions in the world, has issued a formal warning for 2026. Their chief strategist's report, published this month, states, if Trump's 25% tariffs on the EU, Canada, and Mexico are fully implemented by March 4th, we project a 20% correction in U.S. equities within 6 months. Let me translate that. A 20% correction on the current S&P 500 level of 5,680 points means a drop to approximately 4,544 points. That would erase roughly $9.4 trillion in market value, not from some hypothetical future, from your 401k, from your retirement account, from the portfolios of 158 million Americans who invest in the stock market. JPMorgan also flagged, Trump's 25% EU tariffs
will add $75 to $120 billion in costs, paid by American consumers, not foreign countries. Corporate earnings growth, which Wall Street projects at 11% for 2026, will likely fall to just 3 to 4% if tariffs proceed. The Magnificent Seven tech stocks, Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, and Tesla, which represent 34% of the entire S&P 500, are trading at a price-to-earnings ratio of 28, well above historical norms. Goldman Sachs agreed. They lowered their year-end S&P 500 target from 6,500 to 5,900, a downgrade of 9.2%. Both JPMorgan and Goldman Sachs are telling you the same thing. This market has priced in perfection, and perfection rarely happens.
Words are cheap. Let me show you actions. Over the past 9 consecutive quarters, Berkshire Hathaway has been a net seller of stocks. Not a buyer, a seller. Here's what we've done. Apple sold 13% of our position. Apple remains our largest holding at $74.2 billion, but we have been reducing. Bank of America sold 12.7% of our position, over $5.8 billion worth. HP reduced position significantly. New addition, Domino's Pizza, 2.2 million shares, roughly $830 million. Why pizza? Because people eat pizza in recessions. And we have been buying U.S. Treasury bills. At 4.35% yield on 3-month T-bills, that is a guaranteed, risk-free return while we wait for the market to correct. I wrote in my 2025 annual letter, "The prices being asked in passive investing are more foolish than at any time I've seen in my career. We prefer T-bills. That is not a comment. That is a warning." Our cash reserve of $334.2 billion is not a sign of laziness. It is ammunition. When the market corrects, and I believe it will, Berkshire will buy great companies at great prices. That is the Buffett playbook. It has worked for 73 years. Let me talk about the thing that keeps me up at night. March 4th, 2026. That is the date when President Trump's 25% tariffs on Canada, Mexico, and the European Union take effect, unless a last-minute deal is reached. These are not small numbers. The U.S. imports $450 billion annually from Canada, $460 billion from Mexico, $550 billion from the EU, with an additional 10% tariff on China also announced. At 25% tariff rate, the annual cost passed to American consumers would be $45 billion from Canada, plus $46 billion from Mexico, plus $55 billion from the EU, equaling $146 billion per year. That is $146 billion not going into the U.S. economy productively. That is $146 billion in higher prices for cars, food, electronics, and energy. The Federal Reserve is already at 4.25 to 4.50% interest rates. They cannot cut rates easily if tariffs push inflation higher. Core PCE, the Fed's preferred inflation measure, is already at 2.7%, above their 2% target. History teaches a brutal lesson here. In 1930, the Smoot-Hawley Tariff Act imposed 20% tariffs. The result? the U.S. stock market fell an additional 86% over the next 2 years. 25% unemployment. The Great Depression deepened. In 2018, Trump's first trade war caused a 20% S&P 500 correction. The 2026 tariffs are larger, broader, and applied to more trading partners than 2018. The dollar index has already risen 4.2% since the tariff announcement. JPMorgan estimates these tariffs could reduce U.S. GDP growth by 0.5 to 1.2 percentage points. There's a signal that most retail investors never look at: corporate insider selling. When the CEOs, CFOs, and board members of major companies, the people who know everything about their businesses, start selling their own stock in massive quantities, that is a warning sign you should not ignore. In 2025 and early 2026, U.S. corporate insiders sold $12.2 billion worth of stock. That is the highest insider selling figure since 2007. You remember 2007? That was the year before the 2008 financial crisis. Short interest, the amount of money betting against the S&P 500, has increased by 23% since January 2026. Now, here is what I do in times like this. Rule 1. Don't lose money. Rule 2. Don't forget Rule 1. First, review your cash position. If you are 100% invested in equities right now, consider what percentage you are comfortable losing in a 20 to 30% correction. Second, T-bills are your friend. The 3-month U.S. Treasury bill is yielding 4.35% right now, guaranteed by the U.S. government. No stock market risk. Third, avoid leverage. In a correction, leveraged positions are wiped out first. Fourth, focus on quality companies with low debt, strong cash flow, and pricing power. Fifth, do not panic sell at the bottom. The worst investors sell when markets fall. The best investors buy. My $334 billion cash reserve is not fear, it is patience. The Buffett Indicator is at 205%. JPMorgan is warning of a 20% correction. Corporate insiders have sold $12.2 billion, highest since 2007. Berkshire Hathaway is sitting on $334.2 billion in cash. Tariffs worth $146 billion per year take effect March 4th. The question is not if the market corrects. The question is, are you ready when it does? My grandfather used to say, "The time to repair the roof is when the sun is shining." Right now, the sun is still shining, but I am watching the clouds gather. Are you paying attention?